Valuing a commercial bank immediately after a mega merger is notoriously difficult. The balance sheets balloon, and the immediate earnings reports are clouded by the high one-time costs of the transaction. This is Capital One's current baseline. The stock is trading at $242.36, supported by an asset footprint of $682.9 billion across its credit card, consumer, and commercial banking divisions. The May 2025 acquisition of Discover integrated a global payment network directly into the bank's core infrastructure, adding hundreds of billions in assets to the ledger. Standard GAAP net income for the first quarter of 2026 shows an earnings per share of $3.34. However, that figure is temporarily lowered by the technical requirements of acquisition accounting. Once we remove specific integration expenses and the amortization of Discover's intangible assets, the adjusted baseline EPS rises to $4.42. To find the stock's actual intrinsic value, we must move past the headline reports. We will run this adjusted data through the valuation frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham before building a specialized bank-specific DCF model. Finding clarity in the financial sector requires looking past market sentiment and applying strict logic to the underlying data. Warren Buffett's qualitative appraisal focuses on two primary requirements: a durable economic moat and management that is strictly aligned with shareholders. Capital One has distinct competitive advantages. It is the only major U.S. bank fully migrated to the public cloud, and by acquiring Discover, it now controls a global payment network that competes directly with Visa and MasterCard. CEO Richard Fairbank founded the company and takes no cash salary. His compensation is entirely equity-based and deferred for 3 years, which creates a direct incentive to drive long-term share value. While standard return on equity is 7.65%, Buffett would focus on return on tangible common equity. By stripping out the goodwill from the merger, we see a more robust profitability metric of 12.20%. For a bank, owner earnings are approximated by taking net income and subtracting preferred dividends and mandatory regulatory capital. This yields approximately $11 billion in annualized owner earnings. Applying a 15% discount rate suggests an intrinsic value of $190 per share. With the stock trading above $240, this framework suggests the current price lacks the margin of safety typically required for a value-based purchase. Peter Lynch's framework requires identifying a stock's category before analyzing the growth metrics. Post-merger, Capital One is a stalwart, a large, established company, currently behaving like an asset play as it integrates the Discover network. Lynch's go-to metric is the price per earnings to growth, or PEG ratio. We use an annualized adjusted EPS of $17.68 against the current PE multiple of 13.7. Management projects that merger synergies will drive a 15% increase in earnings per share by 2027. Factoring in that growth rate results in a PEG ratio of roughly 0.91. There is one factor Lynch often viewed with caution: the very high level of institutional ownership in the stock. Vanguard and BlackRock combined own more than 17% of the company. In a mega-cap bank of this scale, such concentration is standard and does not necessarily signal a lack of ratio under 1.0. This lens views the stock as a hold with potential for a weak buy, provided synergy targets are met. Benjamin Graham utilized a conservative, quantitative checklist designed for defensive investors who prioritize asset protection over growth stories. The company meets Graham's size and liquidity requirements, with a 173% liquidity coverage ratio and a stable dividend of 80 cents per share. The price-to-earnings ratio is acceptable, but the stock currently trades significantly higher than Graham's strict limits for price-to-book value. This is the Graham intrinsic value formula, modified for the banking sector by using tangible book value per share. Plugging in Q1 2026 data, an adjusted EPS of $17.68, and tangible book value of $107.76 yields a precise intrinsic value of $207.04. Graham insisted on a 30% margin of safety, meaning his maximum buy price would be approximately $145. Since the stock is trading at a 17% premium to its intrinsic value, a strict Graham investor would consider this a sell. Standard discounted cash flow models fail when applied to banks because free cash flow is blocked by capital requirements. Capital One must maintain a common equity Tier 1 ratio of at least 14.4%. This effectively traps capital on the balance sheet, preventing it from being treated as distributable cash. To bypass this, we build a proxy model, projecting the bank's capacity for dividends and share repurchases. Assuming a 10% cost of equity, a 2% terminal growth rate, and a 5% baseline growth projection, this baseline proxy model estimates a fair value of $255 per share. Changing assumptions shifts the DCF valuation anywhere from $190 to over $310. Alternatively, comparing the absolute DCF against a relative metric, like the price-to-tangible book ratio, shows Capital One trading at 2.25 times book value versus the 1.8 industry average, suggesting a $193 fair value. A dividend discount model produces a value of only $80. This highlights that the company is choosing to retain capital for growth rather than distributing it to shareholders. While the DCF model shows slight upside, the relative banking multiples suggest the market is already pricing in much of the expected growth. Aggregating these four models gives us a clear range of fair values: Graham at $207, Buffett at $190, the relative peer average at $193, and the growth-focused DCF at $255. The higher DCF number is supported by the efficiency gains from the merger, with the company currently operating at a 45.74% efficiency ratio. However, risks are present in the credit cycle. Net charge-offs have risen to 3.45%, which will impact the bottom line if the trend continues. The $415 million spent on integration and the $477 million in amortization last quarter show exactly how much capital is being used to combine these two organizations. To hit the projected 15% increase in earnings, management must integrate these systems without further cost overruns. At the current price of $242.36, Capital One is a hold. A defensive investor following Benjamin Graham's rules would wait for a price drop toward $145. An investor using Warren Buffett's criteria would likely see a buying opportunity closer to $160. A growth-focused Lynch investor should monitor the revenue reports. The thesis only holds if top-line growth stays consistently above 15%. The Discover acquisition provides Capital One with significant scale in the payments and lending sectors. However, the current stock price reflects these high expectations, requiring disciplined patience before a clear entry point emerges.